Welcome to Markets Without Spin, the podcast that cuts through financial media noise to examine what's really happening in markets and the global economy. I'm Franz Amundsen. Before we begin, here's a quick recap of where we left off in the last episode, episode 4. In that episode, we explored the rise of indexing and ETFs, how flows overtook fundamentals, how liquidity became synthetic, and why so much of today's market moves on mechanics rather than decision-making. Now in this episode, episode 5, we look at what happens when the passive engine that lifted the markets for 15 to 20 years begins to reverse, and how that interacts with the greatest monetary expansion in U.S. history. And critically, how stock buybacks magnified it all. This is the passive bid, the liquidity mirage, and the monetary flood. For more than a decade, the U.S. stock market floated on two massive tides: passive inflows, automatic 401ks, target date funds, and index allocations, and explosive money supply growth, trillions and trillions of dollars created by unprecedented policy intervention. These forces worked together. They amplified one another, and they pushed valuations farther than fundamentals alone could ever justify. But the tide turns, and both forces are now slowing at the same time. The question is, what markets look like when the mechanical bid disappears and when the monetary flood recedes. Like we talked about in the last episode, every 2 weeks, millions of Americans buy stock without lifting a finger. Their contributions flow directly into funds managed by Vanguard, BlackRock, and State Street Global Advisors. These funds do not evaluate companies. They don't analyze balance sheets. They buy because the index tells them to buy. This price-insensitive mechanical allocation is the passive bid, one of the most powerful forces in financial history. Why has the passive bid lasted so long? Well, 3 massive forces aligned. Baby boomers were still contributing to retirement accounts, tens of millions adding fresh dollars to equities every paycheck. Zero interest rate policy made bonds uncompetitive. When treasuries yielded under 1%, index funds looked irresistible. Target date funds automated everything. Millions placed on long-term equity glide paths without ever making an investment decision. This created valuation drift. Bull markets driven by flows, not fundamentals. Now let's talk about the years of monetary flooding. This is where the mainstream story breaks down. For 2 decades, the U.S. experienced one of the largest monetary expansions in history. Massive increases in the M2 money supply, quantitative easing, fiscal stimulus, credit facilities, and emergency lending programs. All that money had to go somewhere. Economist Steve H. Hanke explained for years, inflation begins in the money supply. New money enters the system at the top: banks, institutions, asset holders. Asset prices inflate first, consumer prices later. The money flood collided with the single most powerful artificial driver of stock prices: corporate stock buybacks. Buybacks transform monetary stimulus into stock market inflation or asset price inflation. Corporations borrowed cheap money, used it to buy their own shares, reduced share count, boosted earnings per share mechanically, triggered executive bonuses and incentive payouts, and drove valuations artificially higher. In other words, passive flows were the fuel, the monetary flood was the oxygen, stock buybacks were the spark. Together, they created one of the most distorted financial markets in history. Well, let's talk about how the money supply exploded, the two great bailouts. To understand the liquidity mirage, we must understand why the money supply exploded and how corporations weaponized it. In 2008, policymakers faced a choice: let insolvent banks fail or shift the losses onto the public's balance sheet. They chose the latter. The U.S. government, with the backing of the Federal Reserve System, bought toxic credit assets at near par. This prevented a banking collapse and injected trillions of dollars into financial markets. Corporations quickly recognized the opportunity. Debt was artificially cheap. Cash-rich companies didn't need to invest. The highest return came from shrinking their own share count. Thus began the buyback supercycle. Trillions not spent on innovation or productivity, but on financial engineering. COVID was the supercharging buyback engine. During COVID, trillions in stimulus hit the system. Corporate credit markets were guaranteed. Borrowing costs collapsed, and many companies resumed buybacks within months, even as the real economy was shut down. This is one of the great ironies of the pandemic. The U.S. saw record corporate buybacks during a global economic contraction. Why? Because monetary and physical stimulus made it easy and extremely profitable to repurchase shares. Buybacks again became the mechanism that channeled liquidity into equity inflation or asset price inflation. Now, officially, the Fed has two mandates: price stability and maximum employment. But in practice, a third emerged: prevent the stock market from collapsing at all costs, because policymakers believe rising markets create a wealth effect. Wealth effect drives consumption. Consumption drives GDP. This created a feedback loop. Feds create liquidity. Corporations use liquidity for buybacks. Buybacks push markets up. Higher markets reinforce consumer spending. Policymakers feel compelled to support the loop. Stock buybacks became the core mechanism sustaining the wealth effect economy. Now there's danger ahead if there's a buyback failure. If markets now expect the Fed to prevent declines, then the next liquidity crisis requires an even bigger rescue. But now the deeper question emerges: what happens when the buyback engine loses its fuel? Buybacks depend on cheap debt, rising margins, steady cash flow, and easy liquidity. Today, margins are shrinking, debt is expensive, cash flows are flattening, demographics are turning negative, passive flows are slowing. The Fed cannot print trillions again without reigniting inflation. The market's largest artificial buyer is losing its purchasing power. And here's the structural risk. The last 15 years of stock performance were built on buybacks, but the next 15 years may not support buybacks at all. This is the trap. To save the market, the Fed must create money. To control inflation, the Fed must stop creating money. Both cannot occur simultaneously. But now we're hit with the structural turn. The largest generation in American history, the baby boomers, are retiring. Contributions stop, withdrawals begin, spending replaces savings, required minimum distributions force asset sales every year. It's arithmetic, not sentiment. For 15 years, markets enjoyed one-way inflows. Now we're entering a decade of structural outflows. With buybacks slowing and passive flows declining, the market is losing its two largest mechanical buyers at the same time. Index funds and ETFs appear liquid until flows reverse. ETF liquidity depends on steady inflows, functioning arbitrage, market makers willing to hold inventory, and corporate buybacks absorbing selling pressure. When any of these weaken, spreads widen, net asset value discounts appear, small cap and bond ETFs dislocate, volatility spikes, liquidity evaporates. Corporate buybacks were a hidden liquidity source, an invisible bid under the market. Remove that bid and the entire structure becomes more fragile. The passive inflow era gave us inflated PE ratios, narrow leadership, mega cap dominance, declining volatility, and extreme concentration. The outflow era begins. It will bring valuation compression, elevated volatility, wider dispersions, fundamentals mattering again, and concentration becoming dangerous. Price discovery, dormant for decades, now may return violently. Who gets hurt and who survives? The most vulnerable are the richly valued megacaps, the heavily indexed names, unprofitable growth companies requiring financing or refinancing, firms whose earnings per share depends on buybacks. The most resilient companies will be the cash-rich operators, low-debt balance sheets, essential service providers, durable dividend payers, short-duration fixed income, commodity producers with true scarcity. These are the businesses that mattered before passive flows and buybacks distorted markets. So what should investors watch? 3 reliable indicators will signal the transition. The first one, the earliest warning indicator, is going to be net 401k outflows. The next one will be accelerating required minimum distribution selling, which is unavoidable, unless the government changes the rules, which they have in the past. ETF liquidity stress during mild volatility, and the liquidity mirage cracking. These are mechanical indicators, not emotional ones. So here's my closing thoughts. For most of my career, markets were shaped by decisions, analysts, managers, and boards. For the last decade, or maybe a little more than that, the markets were shaped by mechanics, passive flows, monetary expansion, and stock buybacks. Mechanics don't care about valuation until the system flips. We are entering both the passive outflow era and the post-monetary flood era at the same time. And the buyback engine that supported a generation of stock prices may no longer function. The next decade will look very different from the last 15 years. This has been episode 5 of Markets Without Spin. I'm Franz Amison. Thanks for listening.